All right, folks, here we are, part 5 from chapter 6. So notice, here's a multi-step income statement. So we got Walmart's name up here. Walmart's name right here. There's Walmart stores, okay? Remember, company name, right? Then we have company name. We have the name of the statement for the year ended, for the years ended January 31, okay? And the amounts are in millions. So by the way, take a look. So here's what's important. There's a gross profit number right there. This is important. This gross profit, this is how much money you're making, how much money you have left to pay all the other bills. So notice there's all these other expenses down here. So this is your sales, this number right here, minus this number, okay? And you got to make sure that this number is high enough. Make sure it's high enough to pay everything else, right? Because you got, this is the sales minus the cost of the item you sold. But you got to pay electric bills, you got to pay employees, you got to pay retirement plans, you got to pay medical plans, you got to pay all this other stuff, okay? Another super important number right here is income from operations, this right here. What this shows you is that after you have gross profit and you're selling general administrative expenses, this tells you, based on your regular business, were you profitable or not, okay? Because notice they have other expenses here. They have income tax expense here, okay? Income tax expense. So there's a couple other expenses, but all those expenses related to your core business, selling general and administrative expenses are there. So this tells you whether or not you have a profit, okay? Based upon your core business. And if you're not, like we mentioned before, if you're talking about Subway, if you're not making money selling sandwiches, chips, cookies, Coca-Cola, whatever it is, and you own a Subway shop, you're not going to be in business very long. So you got to make sure you have enough gross profit, and you got to make sure your income from your operations, from your basic core business, is profitable. All right, here we go. Question 6. Why is the income from operations such an important number? Okay, so make sure you write down the answer to this one because it's going to be on your quiz up there on Canvas. Okay. By the way, a couple other here, we're taking a look at income statements. Notice the gross profit here each year, gross profit. By the way, if you take a look, seems like they're doing a little bit better each year, okay? A little bit better each year. Again, here's that income from operations number, super important. So this is very important. This one right here, and this one right here, okay? Those are important. They're key numbers to make sure you understand whether or not you're being profitable, okay? And then gross profit divided by net sales times 100 gives you a gross profit percentage, okay? Gross profit percentage. Again, another, are we making enough gross profit to pay all of our other bills? Okay. So here's the gross profit percentage from Walmart. Here's your gross profit. By the way, it's not your net profit, gross profit. Divided by your net sales, right? Notice 24.5%. Okay. By the way, it's going down a little bit here. Look, it was 24.9, then it was 24.7, then 24.5. So they're actually, by the way, notice this, their sales are going up. Sales are going up. But it looks like their expenses are going up a little, their cost of goods is going up a little bit faster. Okay? So, again, one of those ways you can evaluate what's going on. Okay? Now we're going to take a look at those cash discounts on purchases and sales. Okay? And the question is, how do we record them? Okay? So there's 2 different ways to record them, and I'll let you know, I think there's one way that's more right than the other, okay? And I'll tell you what that is and make sure you understand both. Okay, so we're going to do purchase and sales discounts, okay? So there's 2 methods, okay? The gross method, okay? Gross method says you record the discount later when the cash is paid or received, okay? And the net method is you record it with the discount at the time of the initial sale or purchase. Now, here's my thoughts on the matter, okay? I think the gross method is a more proper way to do it, because the net method is assuming something that didn't happen yet. Okay, again, this is just my personal opinion. And you can always reverse that if you don't wind up getting the discount. But again, from my perspective, I don't think you should do that. You should wait till it actually happens. Okay? So here's what it looks like. It says here, let me put the highlighter on. It says assume Walmart purchased merchandise at a cost of $1,000. Okay, so $1,000 with terms 2% 30, net 60, offered by its supplier. Okay, so they bought stuff. Now, Walmart's warehouse store, Sam's Club, then sells the merchandise to a local business at a price of $1,500. Okay, so they bought it for $1,000, they're selling it for $1,500 with the same terms, right? Walmart pays its supplier within the discount period, and the customer pays Walmart within the discount period. Okay, so they both pay within the discount period. So here's the gross method. So when they made the purchase, they said inventory $1,000, accounts payable $1,000. So they just put it in there just like regularly straight away what it is. Now when the payment is made during the discount period, what they do, they lower the accounts payable. So these two right here, they're connected. They get rid of that accounts payable. They pay them cash, and they lower their cost of inventory. So what they're doing here is they're lowering their inventory, lower the inventory by the discount. Because actually what happened was, instead of them paying $1,000 for it, they only paid $980. So that lowered, so that 20 would come from here, right? And that would be $980, okay? That's the gross method, and this is for Walmart's purchase, okay? Now, let's say this is a gross method when they're selling, Walmart's selling, okay? So now, when the goods are delivered, they have an account receivable for $1,500, and they made a sale. So they made the sale, right? They made the sale, and they're going to get the money later. And then, because they earned their discount, Walmart did, so their cost of goods sold is $980, and they're going to lower their inventory by $980, okay? Now, when payment is received during the discount period, so now they're giving their customer a discount too, right? So what they're going to do, they're going to get cash of $1,470. They're giving a sales discount of $30, and they're going to get rid of this account receivable for $1,500, this guy right here, okay? All right, does that make sense? So what happens is, so they have a sales discount. So remember, so we could have, so it's kind of like this. So we could have, we have sales, discount, and allowances. Then we have sales discount. Or this is returns and allowances, excuse me, returns and allowances and discounts. And then after that, you have net sales. Again, you would want to know these numbers. You would want to know, well, what were my gross sales? How much stuff got returned, or I had to give an allowance on, and how much did I give out in payment discounts? Again, if you're running a business, having this information is going to help you run it more profitably and better. Okay. Now, the net method, what they do is they just assume everything is getting the discount. So if you take a look here, they put it right in with the discount. Okay, they put it right in with the discount. Now, same thing here with the discount. That's the net method. Now, again, you can go and undo that. Okay, so here, this is all net method. Okay, all net method. Basically, they don't even worry about the discount thing. Now, what they don't show you is that if you do the net method and it doesn't happen, so what would happen? They would have something about there's an account that would be sales discount, unused sales discount, or something like this, right? Where you could undo it. Okay. And unfortunately, let's see here. How would that, let me see if I could show you here. Okay, so what it would be, so for argument's sake, let's say when they purchased it, they said they purchased it within the time frame. Let's say for some reason they didn't. What would happen would be they'd make another journal entry and they would go inventory 20. They would increase their inventory and then they would have sales discount missed or something like this, right? 20. And so what would wind up happening would be, and then they would have their accounts payable would be adjusted with that, okay? And this would go towards accounts payable, all right? Anyway, they didn't show you that part, but. All right, folks, that's it for part 5. We will be back with part 6 of these chapter exercises in just a minute.